All right. Thank you so much, everybody, for tuning in today. Really appreciate it. We have a wild ride in store with taxes. We're going to talk about what to do and maybe even a little bit about what not to do before the year is over. And I'm going to share my screen here in a moment and make sure that's working okay. But the topic of our conversation here is going to be essential tax moves to make before 2025 ends. And we have a special guest here to discuss that, somebody who's been in the industry a really long time, but I will give him a proper introduction here shortly after I do a little bit on what we do here at Sense Financial. Some of you here may already know, but I'm going to do a little refresher. And for people that have never seen us before or heard about what we do, I'm going to educate you on something maybe you've never heard of, which is a super cool thing. So let me get my screen share working and we can make sure that that's okay as people are trickling in. Right. That's full screen, right? Yep. All right. Thank you, sir. Well, very cool. Okay, let's kick it off. So yeah, as I mentioned today, we're going to talk about beyond the deadline. Essential tax moves to make before 2025 ends. We have a special guest here from Robert Hall and Associates, tax consultants, who, as I mentioned, will get a proper introduction here shortly. My name is Brett Sinicki, and I have been a solo 401k and self-directed IRA consultant here at Sense Financial for the last couple of years. And Sense Financial actually started about almost 16 years ago now. It's pretty wild to think about how much time has gone by since the beginning. And during that entire time, we have only specialized in two products, and that's the checkbook IRA and the solo 401k. And I think because of that narrow focus, we offer these services at a very high level, and we're very efficient at what we do. My contact info is there if you want to reach out. Phone call, text, email, anytime is all good. We can schedule a call or just go back and forth through email or text or call, whatever's easiest. And just a little bit of a disclaimer, we're not a fiduciary. We don't provide legal or tax, investment, accounting, or other professional advice. If you need such advice, seek out that proper professional, such as our guest here today. And then just a little bit about us that I didn't already mention. As I said already, we are a boutique financial firm that specializes in self-directed retirement plans that have what's called checkbook control. Checkbook control is a type of setup with a retirement account, an IRA or 401k, that allows you to be the manager of the funds on behalf of the retirement plan and not have to go through anybody, any custodian or anybody else to make the investment. So it's a very efficient way to set up a self-directed retirement account. And I'll talk a little bit about what can be invested in here shortly. As I mentioned, we've been around since 2010. We do have 5-star reviews all over the place: Google, Better Business Bureau, Yelp, LinkedIn. You can check us out on Trustpilot as well. And then to date, we have actually almost 7,000 clients that we've set up self-directed retirement accounts for. And then most of our clients come from referral, not just from business partners like our guest here today, but also from our existing clients. Actually, most of our referrals come from our existing clients because there's so many of them. But I think that's a testament to the service we offer and the high level of the quality of service that we do offer, and people keep coming back and refer their friends and family and colleagues as well. So what are the benefits of a self-directed IRA or solo 401k? Well, first off, it's in the name, right? Self-directed. You get to choose what you invest in. And most of our clients are looking for non-public assets, right? Non-Wall Street assets like real estate, crypto, precious metals, etc. I have on the next slide a couple of the more common examples. And it allows you true diversification, right? You control where the money goes, so you can invest it in assets that you understand and have more control over, therefore have a more predictable outcome. There's no guarantees, obviously, with investing, whether it's real estate or the S&P 500, but when two people are signing on the dotted line on a rental agreement, as an example, or even a private money loan as to what the terms are going to be, it's a little bit more of a guarantee than just throwing your money in the stock market. And look, nothing wrong with the stock market. I have money in the stock market. I think it's okay to do that. And we're talking about true diversification, not just Wall Street, right? Maybe Wall Street plus. And we're not here to give financial advice, just to give you education so you can make an informed decision. Now, these plans can be tax deferred or tax deferred traditional pre-tax funds, or they can be Roth, which of course you pay taxes on today and then it's tax-free after that. Grows tax-free, and then distributions are tax-free as well, as long as you wait till 59 and a half. You can leverage your funds with non-recourse financing. If you want to buy real estate with your IRA or 401k, you can actually get a loan. Non-recourse simply means that the property is the only security for the loan. You cannot provide a personal guarantee. We already covered the checkbook control pretty well. And then the solo 401k, we actually call it the ultimate retirement plan. It's just a massive tax shelter. If you make whether you make tax deferred contributions or Roth contributions, you could call it a tax shelter, and you can contribute up to $77,500 for 2025. I understand that might go up by $1,000 or so for 2026, though those numbers have not been released officially yet. And if you're under 50, it's $70,000. So you can contribute quite a bit from your business income to a solo 401k. And one more note on that, if you are married and your spouse can also participate in that solo 401k, those numbers double, right? So you can potentially put aside $140,000 of pre-tax traditional funds to invest in alternative assets for retirement, or Roth, or a combination of the two. So pretty cool when you consider that an IRA is only $7,000 a year, or $8,000 if you're over 50. I mentioned this already, virtually unlimited investment options. IRS doesn't tell you what you can invest in. They only tell you what you can't invest in. I'm not going to get into that today, but these are some of the more common examples. Real estate, both commercial and residential, private money lending, cryptocurrency, precious metals, and the list goes on. And I already mentioned this, true diversification, so you don't end up like this elderly couple here with their eggs in one basket falling down. Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth. And hopefully there's nothing on the horizon. We've had a great run in the stock market and real estate for the last several years, for that matter. Little ups and downs here and there, but it's done pretty well the last couple of years. With that said, I want to now introduce our guest speaker. I'm joined by Tony Watson with Robert Hall & Associates. Tony personally manages clients with over $500 million in real estate holdings. He has spoken for hundreds of trade organizations throughout the state of California. Holding a federal license as an enrolled agent tax practitioner, Tony can advise, represent, and prepare tax returns for individuals, partnerships, corporations, and any other entity with tax reporting requirements. Aside from his full-time position at Robert Hall & Associates, Tony is an active real estate investor, entrepreneur, and enjoys short and long-term trading. With over a decade and a half of experience, Tony, along with his team at Robert Hall & Associates, actively look for the newest and most up-to-date strategies to implement for client tax filings. They all operate with the same goal in mind: to help taxpayers keep more of their wealth and not overspend with the federal and state revenue agencies. Isn't that the goal? Tony, my friend, thank you so much. I'm going to stop my screen share and let you take over.
Brett, appreciate it as always. Thank you so much to you, the team at Sense Financial. Just like yourselves, I mean, I've been in the industry around 20 years. I met Dimitri, over a decade and a half ago, probably one of my longest time friends, clients, and vendors that I've done business with in my career. And I can't stress this enough, how important this relationship is for me as a tax advisor. A majority of what we do throughout the calendar year is plan ahead, right? That's the power of planning. We call it POP in our office, right? Kind of cheesy, but it works. The power of planning. And when you take the tax world and you apply the planning methods that we have in play for us as we kind of strategize with our clients, self-directed IRA and solo 401k deferral investments are top of the list. Because why would you not take advantage of paying yourself, moving money from one of your personal accounts or business accounts into a deferred retirement account, deferring the tax, right? Kicking that tax can down the road until you retire, or as long as you possibly can, so that it doesn't bump you up into a higher income bracket, and avoid paying Uncle Sam, right? But on top of that, Aside from the traditional 401ks and the IRAs, the beauty of the self-directed accounts is that you get to diversify those investments. You get to diversify within the tax-deferred investment account. And so Brett had showed you a screen about all of the alternative assets that you can invest in. Just from a personal standpoint, with my 401k, I self-direct a lot of my investments as well. But when you take a look at the close to 1,100, 1,200 tax returns that I prepare on a year-to-year basis, the amount of wealth that my clients have been able to build by self-directing their investments while still having their stock, assets like the Googles and the Nvidias and things like that sheltered in those accounts, the ability to diversify into lending, into real estate investing, syndication types investments, the wealth that they built for themselves over my career of 20 years is exponentially greater than somebody who just has let their money ride in a single asset. And I wish I had a chart that explained all of that, but it's all personal information. I can't share that with you today. But that is something that I have noticed year over year, how people have decided that I want to take control over my retirement investments while still having my advisors in place. Obviously, people don't have that much time to manage their retirement accounts most of the time, but they have all the right professionals in place, all the right vendors in place, and the amount of wealth that they've been able to build for themselves and defer the tax on, it's a wild amount. I can tell you that. So today we're going to talk about the importance of year-end planning, key moves to make prior to the end of 2025. And one thing that makes this conversation very unique is the fact that just a couple months ago, right, back in July 4th specifically, the IRS and the current administration introduced a new tax bill. I don't know if you all know this, but since 1960s, early 1960s, I believe it was 1962, the real estate professional tax code has been set in play to help real estate investors and other like-kind asset investors really shelter a majority of their income through non-passive type investments and expenses. My personal expertise is in tax code, obviously, but I work a majority of the time with real estate professionals and small business owners. When I first started off in the tax industry, I would have, households of 2 teachers come in and file their taxes with us. Fast forward to 2025, 2026, a majority of my clients are these self-employed individuals who now have the ability to put themselves on payroll, diversify their retirement investments by deferring money into retirement accounts. My planning has changed. My approach to planning has changed over the years. So I'm really excited heading into the end of 2025 for a number of reasons. I do believe, politics aside, guys, politics aside, okay, I do believe that this particular tax bill, the big, beautiful bill, is probably one of the most forward-thinking, pro-business tax codes that we have ever seen. At least in my 20-year career, in the 55 years that Bob Hall has been open and operating, I think we all agree in our office that the changes under the big, beautiful bill have really brought back, well, they first have brought back Trump's first administration changes when his first tax code was released, but then they kind of lit a fire or pumped it full of steroids to get people more involved in their own planning process, in their planning stage, I guess, because it's important. It's important to plan ahead. It's important to look forward into future years, especially if you're trying to build wealth for yourself, right? Which that's why we're all in business. But most importantly, if you're concerned about keeping that wealth, that's what it truly comes down to. You can make all the money in the world, but if you don't plan ahead, it could go away. Maybe not overnight, but you could slowly start to lose all of that traction, all of those gains by not planning ahead, simply by overpaying in federal and state income tax. So without further ado, key tax moves to make before 2025 ends. Just so that you know, I'm not a one-man show here at Robert Hall & Associates. We have 53 staff members on deck at Robert Hall & Associates, and we need this kind of man and woman power to service roughly our 11,000 plus tax filings on an annual basis. We do file taxes across the U.S., not only here in the state of California. That's one thing that's very unique about our enrolled agents, what we consider to be a boutique accounting firm. So if you have investments outside of California and you're concerned about the tax implications in Wyoming or Missouri or Mississippi or the Virginias, we can assist with the tax filings and the planning around those assets. Most of the time when people live here in California or live in any state, and then they have investments outside of that state where they currently reside, those investments tend to default to passive investments. But under this big, beautiful bill, there might be a way for specifically real estate investors to operate their real estate related investments, their rental properties, in a different light. Such as the STR rules that have been kind of, once again, pumped full of energy or pumped full of steroids, allowing some individuals now to navigate around certain limits under the Internal Revenue Code and now take full benefit of STR means short-term rental, take full benefit of these short-term rental loss deductions and tax shelter benefits. So keep all of that in mind. I'm gonna go through a lot today, but as far as the detailed breakdown and how it specifically relates to you, I do want to mention that we are open and operational for free consultations. And what I would suggest for you all to do is at the end when we do Q&A, I will show you a little QR code. I'll give you my email. Reach out to us. Send us copies of the most recently filed return. Let us review what you've returned or what you filed for 2024 and 2023. And then we could put a plan in place moving forward. See if we need to go back and amend anything potentially to get you some money back if you missed out on a certain tax shelter benefit of some sort. But I would suggest doing that. And I will give you my contact information at the tail end. I'll show this particular screen when we wrap up, which is the QR code to sign up for the free consult and my email, but we'll get to that at the end. I do want to mention I'm not a legal advisor, okay? So everything that I talk about today is specifically from a tax and income tax preparation and planning perspective. Anything that you take away from today that you think is legal advice, please, I have to let you know, you got to take that to your attorney and ask them. Pay a consultation fee with your attorney just to get the right legal advice, because I am not an attorney. I am solely a tax professional and a tax planning advisor. So our attorneys forced me to throw that up here. Okay, so why do I think it's important for us to plan prior to the end of the year? Well, I've asked clients in the past, why do you think we're meeting today? When clients say, well, I don't even know why I scheduled this appointment, I say, well, why do you think it's important for us to meet today in November or December or even in October? We start year-end planning literally the day after the October 15th deadline in most cases. So when clients come in and they're kind of confused as to why we're meeting because tax season isn't for a couple more months, I say, well, most people will want to get ahead of the curve, right? They want to put a plan in place to, number one, avoid unnecessary penalties and interest. You want to do everything in your power to avoid overpaying the federal government. Now, there are unique scenarios where you might, as an investor, choose to keep most of your cash liquid, so you avoid prepaying estimated tax payments throughout the year. And at that point, if you're holding on to your money and decide to pay the taxes with the actual tax filing in the following year, yes, there may be a 2.2 to 2.5% interest or penalty amount on that liability. However, if you're talking about keeping $50, $100, $200,000 of cash liquid in your account throughout the year rather than prepaying your estimates, you got to make sure you're putting it to work, right? This year in particular, I've had clients earn 10, 15, 20+% ROI on their cash because of the way the market has been ebbing and flowing. So why would we not take a look at the benefits of keeping your cash liquid, investing that money into certain assets, earning 10, 15, 20%, and sure, on the back end, knowing in the back of our mind that even though we've made 20, 30% ROI, there is still that 2.2 to 2.5% penalty on the back end when we file. But at least we're putting the money to work for you, rather than prepaying the federal government. Now, I'm not telling you to go out and not pay your estimated tax payments. I'm telling you that this is all through proper planning. Let the tax advisors take a look at your bottom lines, send you out from that year-end planning consultation to reinvest profit back into infrastructure, helping you reduce your taxable income, saving you money on the back end. And then let's take a look at what kind of ROI you're making in your brokerage accounts or your retirement accounts. Maybe it makes more sense for us to at least skip the fourth quarter payment, keep the money in cash flowing positions, earning more than that eventual 2.2 to 2.5% penalty that you'll pay when we actually get ready to file. Hopefully that makes sense. Once again, I'm not advising you on that to do that right now. I think that it's best for you to sit down with one of our senior advisors and let us map that plan out for you, okay? But the number one answer with this question is, why is it important to do year-end planning? It's to avoid unnecessary penalties and interest. That's number one. Number two, to position yourself for a greater tax benefit. As you can imagine, Brett had showed a screen about how you can defer up to $77,500 into a deferred retirement account. Well, if you are a self-employed individual single individual, or if you're married and let's say your spouse is a self-employed individual, and this year has been just gangbusters for you. The profit is through the roof. It's looking much different than years past. Now you're worried about offsetting all of this profit, right? And avoiding, not evading, because tax evasion is illegal, tax avoidance is not, but properly avoiding income tax on all of this gain that you've made, all of this profit that you've been able to retain over a 12-month period. Well, if you sit down with your accountant during tax season next year and expect to do tax planning for 2025 in 2026, there might be a couple things that we can do, but a majority of the planning and the strategizing has gone away. It's water under the bridge, or not water under the bridge, but it's past, right? You can't make those major shifts or major changes or investments or implement those tax shelters in the new year because that would be for 2026. So prior to December 31st, if you sit down with your accountant, we map out your year-to-date income, your year-to-date expenses. Maybe it makes sense to put you on payroll through a self-employed business, allowing you to put not only an employee contribution into a self-directed IRA or a solo 401k, but also have your company contribute. And this is specifically for the solo 401k, but also have the company contribute as a profit share contribution all the way up to $77,500. Now, in order to make that massive contribution and defer the tax on that amount, you do actually have to be on payroll. In order to contribute to a solo 401k, you have to have earnings. If you're already wiping out all of your company's profit or all of your net taxable income with expenses, you're probably not going to have any earned revenue that qualifies you for making certain contributions to your retirement plans. Like I said, we're not going to go into too much detail about that today. I do want to whet your palate, though, so to speak, and help you understand that you won't know what to put into your 401k. You won't know what to contribute to an IRA. You won't know what to spend your money on prior to the end of the year to help you keep more of your profit in your own bank account without putting a plan in place. So December 31st is a really important date. This would be number 2, to position yourself for greater tax benefit. Number 3, this is probably the most consistent thing on my end because I already do the planning and I position myself for greater tax benefits, things like that, and I want to avoid penalties and interest in certain instances. But probably peace of mind is the most important thing for people. They want to make sure that come tax time, there are no surprises. In my industry, surprises are not good, right? We need to get ahead of the curve. We need to sit down prior to the end of the year so that we map out what your projected bottom line liabilities or refunds look like. And that way, when we head into tax season and we meet for actual tax prep work, you already know kind of the results, right? It might be off by a couple $100 because the December is kind of a wild month. You're buying presents, you're traveling, so on and so forth. So it might create additional tax sheltered write-offs. But at the end of the day, you have a better understanding of what the potential bottom lines will look like before the end of the year. So number 3 would be peace of mind, knowing what the results are before the tax appointment. And I think peace of mind is a really powerful position to put yourself in just from a helping you sleep better at night perspective. And also knowing what cash you have available if an investment comes along or if you need to make that added contribution or bump up your profit sharing plan to your solo 401k, you know that you have that cash available to do so. That's an incredibly powerful position to have and to be in. Do you have to make estimated tax payments? This is one thing that I mentioned just a couple minutes ago. It really all depends. I have a number of clients who are investors. I do about 1,100 tax returns on a year-to-year basis. Most of my clients are real estate investors, but then they also choose to invest their money in alternative assets, as well as sometimes doing short-term loans, to gap funding type situations and scenarios. And so they choose to keep their cash more liquid. So do you have to make estimated tax payments? It really all depends. If you are going to make estimated tax payments, though, you want to make sure that in order to avoid penalties and interest, you know the rules. Get this, the federal government requires you to pay 90% of your current year liability or 110% of your prior year liability, whichever is actually less. I keep forgetting to change that word. It's whichever is less. It's not whichever is greater. Okay. But get this. So when you sit down with your tax advisor, if your tax advisor gives you these quarterly payment vouchers, the software automatically calculates last year's liability times 110%. The federal government would love you to overpay them so that they can control the money that they are eventually going to refund to you. Now, the government's falling apart right before our very eyes. 35,000 agents were let go earlier this year. They're set to furlough by year end. Total, another 30,000 agents. The government's in a complete shutdown. I just read an article that 1,200 flights are being canceled because the FFA can't find employment. I mean, the federal government is a complete mess right now. We're focusing on tax code, right? And so we have to make sure that ignore the noise, ignore the politics, ignore everything that doesn't really directly impact your ability to plan ahead and keep more money in your pocket. I do not like this particular part of the code. I feel like it's almost on a criminal level where the federal government would require you to pay 110% of the prior year liability even if you've made less income. But here's the kicker. If you don't have a tax advisor telling you this, sitting down with you on a quarterly basis or maybe twice a year outside of the tax prep appointment, you might be making these quarterly payments even though your revenue is a little bit slower for 2025. Now, all of a sudden, sure, tax season comes, you're getting this big refund, you're happy with the refund, but think about the opportunities that you lost in 2025 by not having all of that refund liquid throughout the calendar year. So once again, it all comes back to proper tax planning. I can't stress that enough. If you are wanting to prepay your liability and ensure that you're going to get a refund, sure, you got to follow these calculations. 90% of the current year liability or 110% of the prior year liability, whichever is less, okay? Whichever is less. I apologize for the typo there. As we head into end of fourth quarter planning, because we're already in November 7th today, right? As we enter into November and then into December, and the last 2 weeks of December are always kind of wild. People are traveling, the holidays, so on and so forth. You got to put a plan or start a plan right now in November so that you can enjoy the holiday season, right, as much as possible. Probably not flying anywhere anytime soon if the FAA doesn't find any more employees to man those the towers, or whatever they're called. But at the end of the day, you're going to want to sit down as soon as possible and figure out what your net profit is. And when you leave that appointment with your tax advisor, they're going to send you out to reinvest profit back into infrastructure, right? Well, if you already plan to max out your 401k or your IRA contribution, what other top deductions can you go out and spend money on in order to help you reduce taxable profit, helping you keep more money in your pocket, maybe upgrading computer equipment, things that make your business operations more efficient, all of the above, right? I'll give you the top 5 deductions as we enter into end of Q4. Number 1, marketing and advertising. If you are a self-employed individual and you are in the service industry, e-commerce industry, it really doesn't matter what industry you're in. Marketing and advertising is one of the greatest tax shelter deductions under the tax code, in my opinion. It is a true dollar for dollar reduction of taxable income, not only on the federal side, but also on the state of California side. And the reason why I bring that up is because California doesn't conform to everything under the IRS code, right? And we'll talk about a couple things that California doesn't conform to. This in particular is a deduction that California allows dollar for dollar. So go out and revamp your website, print out new business cards, create branded material. That's my wife's business, the industry that my wife works in. All of the Robert Hall & Associates sweatshirts that have the labels and the logos on them, her company produces all of that for us. And so it's a dollar for dollar write-off for Robert Hall & Associates, whatever they spend on those items. Number 2, professional supplies and equipment. Every year, something new comes out, right? This year, I had to upgrade my laptop because one of my close friends and also business associates, his home burned down in Altadena in early January, and he lost everything. Literally everything. The clothes, everything. The clothes that he had on his back were the only thing that was saved. And so we raised a lot of funds for him. We got a lot of clothes for him, but he was without a laptop. So I gave him my old laptop, which was perfectly fine. But I went out and bought a new laptop. Well, this laptop is a dollar for dollar deduction now that 100% bonus depreciation is back in play, which we'll also get to in a second. But this laptop that I'm using right now, great dollar for dollar write-off for me for 2025. So if you need to upgrade equipment, office furniture, supplies, things like that, things that will make your business operations more efficient, go ahead and do that. These are great dollar for dollar deductions across the board for federal and state purposes. State might have a little bit of add back on the computer depreciation, but it's not a whole lot. We're not talking about a car purchase, for instance, which could be 60, 70, 80 plus $1,000. And California does not conform to the bonus depreciation rules on vehicles as of today. Let's knock on wood, whatever piece of wood is close to you, let's knock on wood and hope that California ends up conforming to this part of the tax bill. But as of today, California does not allow for that windfall benefit or that large capital event deduction for you as a business owner. But car and truck expenses, one of the more common deductions in the self-employed world. Obviously, you have to drive to pick up supplies. You have to drive to your listings. You have to drive for a number of things, right? And so people tend to come into our office and say, well, I put 25,000 miles on my vehicle this year. What's my write-off? Well, I say we got to take that 25,000 miles and break it down into 3 buckets. We got to break it down into personal mileage, commuting mileage, and business mileage. Okay? Business mileage is the write-off. Commuting and personal mileage, not a tax deduction. Now, I have yet to see in my 20-year career, in an audit or under audit, the IRS actually audit car and truck expenses, which is wild, right? You'd think that people lie about their mileage all the time. There are smartphone apps and smart device apps like MileIQ that will help you track your business mileage for tax purposes. And I have yet to see in my career, in 20 years, I've yet to see the IRS audit car and truck costs. And that's across the board. That's not only with mileage, that's also with oil changes, tire replacements, engine repair, and above and beyond that, depreciation on the vehicle. So I think that on top of these being the top 5 tax deductions, I also want to mention that these also have some of the lower audit risks. Out of all deductions that you take on your return, some of the lowest audit rates across the board on these deductions. As of July 4th, the federal government brought back this 100% bonus depreciation, which is actually slide number 5 that we're going to talk about. So I will get to that in a second. If you're not looking to purchase or lease a vehicle, you're more likely than not going to lean on the mileage deduction, which lands between 62 and 65 cents per business mile. And at the end of the day, I'm not going to require you to show me a mileage log. We can go over that in our meeting. But you do want to have a good idea of how many business miles you did put on your car, just so we're not, seriously overstating your mileage deduction. We want to make sure that we keep within the compliance measures of the IRC. Okay, so number 4, legal and professional fees. A lot of people back in 2017 thought that when Trump's TCJA Act was passed, that legal and professional fees, including tax preparation fees, were no longer a write-off. That is far from the truth, okay? Legal and professional fees are still tax deductible for W-2 wage earners on the state side, but not on the federal side. Okay, that's for W-2 wage earners. When you are self-employed, or if you're a real estate investor and you have passive or non-passive income, legal and professional fees are still dollar for dollar adjustments to your self-employed non-passive or passive income. Whether it be real estate related, e-commerce related, let's say you're a contract physician and you fix people's hearts or brains, right? And you are self-employed being paid through your corporation, legal and professional fees still a great dollar for dollar deduction. So keep all of that in mind. A lot of misinformation about this particular deduction back in 2017 to 2018 still continues to be a pretty sizable write-off for a majority of our clients. Last but not least, as of July 4th, or actually prior to July 4th, cost segregation and bonus depreciation for vehicle purchases, it was set to decrease down to 60% or 40% this year, and it was decreased to 60% last year. Well, as you can imagine, if it was 60% in 2024, 40% in 2025, 20% in 2026, and then it goes away completely in 2027. That was part of the Inflation Reduction Act, which was Biden's tax code. Fast forward to July 4th, when Trump introduced his new tax bill, the big, beautiful bill, he then retroactively went back and pulled TCJA Act tax code and put it back in place, right? So not for the years that Biden was president, but he took everything from the TCJA Act and he extended it past 2025, which in turn brought back 100% bonus depreciation. Now, what does that mean from a business perspective? What does it mean from a real estate perspective? Well, let's say that on December 12th, we meet to do year-end planning. And we're looking at $100,000 of net profit through your business or through your real estate portfolio. And I ask you, well, what's your car situation looking like? And you say, well, my car is a 1997 Toyota Corolla. I could probably use a new car. The engine's kind of on its last leg. I was really looking into getting, let's throw out a vehicle, a Chrysler minivan, right? Chrysler minivan's way over 6,000 pounds. So as of July 4th, if you go out and you acquire this vehicle for business use, you title, you insure, and you pay for it in specific ways, which our accountants, our consultants can go over this with you, you can actually take advantage of this deduction dollar for dollar because it weighs over 6,000 pounds. Dollar for dollar means if you have $100,000 in profit and you pay $45,000, $50,000 for a Chrysler minivan, once again, you got to title, insure, and pay for it in the correct ways. We can guide you through that. That is a $45,000 to $50,000 adjustment to your $100,000 write-off. or $100,000 of income. Now, that's a Chrysler minivan. Let's say you go out and you buy the brand new electric Rivian vehicle, Rivian truck, which weighs over 6,000 pounds. Those are around $90,000 to $100,000. You have the potential, whether it's on June 15th of this year, September 15th of this year, or even December 31st of this calendar year, you have the ability to go out and acquire this vehicle and completely wipe out all of your federal taxable profit. $100,000 purchase, $100,000 of profit. Now you are down to $0 in net profit through your business, paying nothing in federal income tax on all of your earnings. You do not have to buy this vehicle outright either. You put $1,000 down, you put $5,000 down, you put $20,000 down, whatever gets you the better interest rate on the car loan, and you can still fully accelerate dollar for dollar 100% of the depreciation write-off. It is one of the greatest adjustments you can make in one day. In one calendar day, right? Literally on December 31st, you go out and buy this vehicle and wipe out your net profit. It's not something that you have to hold for a 12-month period. So I don't want to go too much into detail about this. I feel like I'm spending too much time on it. Sign up for the free consultation. Our senior consultants can walk you through how to take advantage of this part of the tax code. And that's on the vehicle side. If your car is fine, don't go out and buy a new vehicle. I am not the person who's going to send you out to spend money just to save tax. But if you are already currently shopping for a vehicle, or heaven forbid you've already bought a vehicle this year, let's take advantage of that bonus depreciation write-off as much as possible. So that's on the vehicle side. On the real estate side, once again, bonus depreciation was set to phase out by 2027, right? So you're looking at this massive windfall benefit back in 21 and 22, but then since 2022 under the Inflation Reduction Act, every year it has lost the wind in its sails, right? Now that it's back at 100%, that means that if you have bought a new rental investment this year or last year, it usually works for the first 3 years of ownership. It does work for properties that you've owned for more than 3 years, but we got to look at the numbers and make sure the cost analysis makes sense. How much is it saving you? How much is it costing you to do it? We just got to make sure the numbers make sense. But this works best for new acquisitions or acquisitions of real estate investments over the last 2 years, 2 to 3 years max. This allows us to go out and, hypothetically speaking, buy $1 million property, which is then split between building and land, right? So let's call it 65% building, 35% land. Well, the 65% building is the depreciable asset. The 35% land, it is what it is. It's just land. It doesn't do anything. It just sits there. The building at $650,000 in this case, if we throw that address into a cost segregation preliminary analysis, we might be able to squeeze $300,000, $400,000 plus of depreciation out of that $650,000 asset in 1 year. Not over 27 and a half years, which is the depreciable lifespan of a residential rental investment. We can fully accelerate that deduction dollar for dollar in 1 year. Now, unlike the vehicle depreciation where the government allows the car depreciation as a write-off, California does not conform to that. California conforms to cost segregation. So that means that if you go out and you do a cost seg on a new investment property and you get, let's say, a $400,000 write-off, both the federal government and the state of California will allow that dollar for dollar adjustment. Whether you individually are able to take that massive loss is a different story. There are other parts of the code that you need to be aware of, the non-passive versus passive activity rules and limits, the real estate professional elections that you have to make in order to accelerate the loss to offset other taxable income. As you can tell, there's a lot that goes into this type of planning if you are out there looking to take advantage of cost seg and bonus depreciation, okay? I wanted to whet your palate once again about this part of the code because we are now back to 100% deductibility of this depreciation write-off. If you are not taking advantage of these parts of the tax code over the next 2 to 3 years, and let's say that let's say a Republican is not the successor of the Trump administration and another Republican in the next 2 to 3 years, I would put money on it that a lot of these benefits will go away completely. I don't even think they'll be phased out at that point because the Biden administration, the Democrats, were already trying to phase this out by 2027. Trump wants this in place until the end of his term. If J.D. Vance replaces him, more likely than not, all of this will be extended further. If he is not replaced by Vance, replaced by somebody in the Democratic Party, more likely than not, we will revert back to the Inflation Reduction Act. Remember, I am not here speaking about politics. I don't weigh on one side or the other. I am giving you straight facts about tax code and the different approaches to the tax code changes that both political parties tend to make. Right? This, once again, like I said earlier, is probably one of the most pro-business tax codes that I have ever seen in my entire career. And this in particular is one of those parts of the code that if you don't take advantage of it, you're leaving a lot of money on the table. I'll leave it at that. As we approach year end, just understand as well that there are significant differences between the deductibility of mortgage interest expenses, whether it's on a primary residence versus a rental property. Back in 2018, when Trump's first administration was in play, and nothing changed during the Biden administration for this, they started limiting the amount of mortgage interest that you could write off on your primary residence, the home that you currently reside in. With a rental property, there are no limits. That's one of the beautiful things about an investment property is that you can go out and have $40,000, $50,000, $60,000 of interest. Let's say you got a crazy high interest rate loan, high property taxes. Let's say you put a bunch of money into improvements throughout the year. You have high insurance now here in the state of California, and probably in other states as well nowadays. But all of a sudden, all of these deductions are dollar for dollar deductible to offset your rental income, the money that you're bringing in on the investment property. Whereas the primary residence, you're only allowed your mortgage interest and your property taxes. And guess what? Both of those have limits to what you can deduct, right? So if you're looking at these two things here, just remember that a rental investment does not see the same limits, tax code wise and deduction wise, as a primary residence does. You want to jump more into detail about that, sign up for a free consultation. We can go more into detail about that. Now, obviously, Sense Financial, one of the greatest vendors that we do business with, has helped our clients at Robert Hall & Associates defer tax liabilities on contributions over the past 14, 15 years that I've known Dimitri and Sense Financial. Just understand, once again, like Brett had mentioned, it's all about diversification, right? Instead of being stuck in one particular brokerage investment where it just ebbs and flows with the S&P 500, and in the long term, sure, it's gonna beat the market every time. The S&P 500, historically speaking, statistically speaking, it has always been the greatest long-term investment, but you got to weather the storms, right? You got to weather the up and down, the ebbs and flows, the different presidential shifts and changes and legislative changes, things like that. And most people don't have the ability, they don't have the gut to just sit there and let their money ride. And when it's down, they don't have the gut or the they don't want to put more money in because they're afraid they're going to lose it, right? So just understand that since I think 1974, it was the early 70s, I think it was 1974 when self-directed retirement investing came about, you are now able to diversify from stocks into real estate and business. And this is something that we help out on the tax side with. As far as your investments are concerned, like what you choose to invest your retirement income in, there are other vendors that we can connect you with. Sense Financial probably has a number of vendors that they work with as well. But we handle everything on the tax compliance side. What needs to be filed, what needs to be reported, what forms go to the IRS, what forms go to the state, what is possible from a tax sheltering perspective. So that is what we do on our end. We are not going to take your money in your self-directed 401k or solo 401k and go out and help you buy real estate. That's not our job. You'd have to talk to a vendor or a professional service provider on that end. But we have a number of people who we can connect you with. Also, one thing that did not go away, thank the good Lord, is the QBI deduction. QBI stands for Qualified Business Income. This essentially states if you are married filing joint, you're going to go to the blue column. If you're single or head of household, you're going to go to the red column. As long as you do enough planning prior to year end to get your married filing joint taxable income below $200, or if you're single head of household down below $182,100, the first 20% of your self-employed or non-passive passive income pays nothing in federal income tax. The first 20% of that. So let me give you an example. Let's say husband and spouse, or a married couple. Let's say they're both self-employed, both real estate professionals earning commission income. Let's say they both bring in 150 grand each in net taxable income. This is after they've deducted all of their expenses. So 150 grand, they're at $300,000 in, let's say, taxable income. Well, 300 grand as a married filing joint couple is below $364,200. So that means that full-blown QBI benefit sets on their tax return. That makes 20% of $300,000 tax-free on the federal side. California does not conform to this. California does not have the same benefit. But this is a massive windfall tax savings benefit for you as long as you can drop your taxable income, not adjusted gross income, but your net taxable income below one of these two thresholds prior to year end. So don't you think it's important? Once again, I hate to sound like a hamster on a wheel here, but don't you think it's important to sit down with your tax advisor and figure out as many creative ways to drop your taxable income below this this income threshold, not only dropping you from a higher bracket to a lower bracket, but now qualifying for 20% of your self-employed income or real estate passive, non-passive income to be tax-free, right? And this doesn't have to be solely through cost seg. It doesn't have to be solely through, buying a vehicle and accelerating bonus depreciation. This could simply be by maxing out your deferred retirement contribution. It could be a number of things. I have seen true example, like this is a personal example with a client, can't name his name, but with a client who was sitting at around $650,000 to $700,000 of income heading into Q4. Came and sat down with me at Robert Hall & Associates. We were able to max out deferred comp, put him on payroll. He ended up doing cost seg because his wife was a real estate professional and had some rental properties. We were able to do cost seg on the rental properties, and they also went out and accelerated depreciation on vehicles and everything. And through those three triggers, those massive adjustments prior to year end, they dropped from $650,000 to $700,000 below the threshold, now qualifying for 20% of their federal income to be received tax-free. Okay. I don't know what better example I can give you. It all comes down to proper planning and strategizing. Keep all of that in mind. Brett had mentioned something earlier. You're probably not going to remember this slide in his presentation portion today, but he had mentioned something about non-recourse loans that you can take from a self-directed IRA or a solo 401k. I forget which one he was talking about or discussing at the time. This is really important when you are starting to diversify your investments outside of your retirement account. Okay, because I have clients who have syndications and real estate and loans, everything written under their solo 401ks and self-directed IRAs, and then they also have personal investments, right? Well, a lot of clients get caught up in the fact that they get pitched on this syndication. And they say, okay, well, it's going to be cash flow over a 20, 30-year period. It's got a big real estate syndication investment within the fund, and you're going to get these massive write-offs up front because we have cost seg going on. We made major improvements. We're accelerating depreciation, so on and so forth. So they're pitching it to you as a long-term cash flowing investment, but in the immediate present, they're pitching it as a tax sheltered deduction. About 6 or 7 out of 10 times that is the case. It works perfectly. However, a small portion of the time when we get these syndicated investment, what are called K1s, if your basis in the investment, you as the partner, you as the investor, if your basis is not equal to the amount of loss that they are allocating to you, you are not able to take that as a deduction. Basis is super important. Basis is when you take $50,000 of your personal funds, you buy into the syndication, immediately your basis in that investment is 50 grand. Well, let's say that they do a cost seg election that allows you $150,000 of deductible losses. Well, the federal government back in 2021, 2022, they revamped a form called a 7203 basis calculation form, which states that if your basis is only 50 grand, and this syndication passes through 150 grand in deductions, the only amount of that 150 grand that you can take is $50,000. Because all of a sudden, the $100,000 in excess loss is creating negative capital basis for you in this investment. The reason why I talked briefly about non-recourse and non-recourse debt is that if on that K1, this scenario occurs where you have $50,000 in basis, 150 grand in loss, you have to make sure that the syndication is allocating non-recourse debt on that K1, because non-recourse debt is added to your $50,000 basis, right? So if you've got a $300,000 non-recourse debt, $50,000 initially invested, you've got $350,000 in basis, which now allows you to take the full $150,000 loss. Very complicated part of the code. Okay, I'm sure that people are falling asleep at their cameras right now. I would be too if it didn't make me so excited to talk about this stuff. Just understand that what they're pitching you as far as investment opportunities are concerned, as soon as they breach or cross that threshold into the tax advisory world, we need to be involved in the conversation. Okay, because you are pitched on the benefits, right? And it all sounds good on paper, but as soon as it passes through to you individually, if certain qualifications aren't met, you might not be allowed that full deduction. So just be aware of the basis limitations. Let us take a look at all of that for you. Once again, non-recourse debt, qualified non-recourse debt, and recourse debt, we got to make sure that we are using the right debt adjustments to increase your basis in the investment, okay? And I'm sorry, it's once again, it's not non-recourse debt, it's qualified non-recourse debt and recourse debt that can be added, not just simply non-recourse debt. Recourse and qualified non-recourse are the only amounts that can be added to your capital basis and allow you that flow-through benefit, okay? Very complicated, I understand. I just wanted to once again whet your palate on this and make sure that you understand that if in past years you have been meeting that qualification, but let's say your tax advisor didn't understand the capital basis adjustment because of certain types of debt, you could be leaving, I mean, no joke, hundreds of thousands of dollars in saved tax liability on the table, simply because your tax advisor didn't understand how the basis calculation form worked. Okay, just to throw that out there. So once again, all very important on the basis side. Getting into kind of a overall macro summary of the Big Beautiful Bill. Once again, Big Beautiful Bill extends everything from Trump's first administration TCJA Act indefinitely. It was supposed to expire in 2025. He has now brought it back and extended it indefinitely. Child tax credits are going up from $2,000 to $2,200 per child. The SALT deduction cap, which mainly affects California and New York, those are the two states because we pay high state income tax and we have high property taxes. The SALT deduction raises to $40,000, but there are limits that apply, okay? Your household has to make under $500,000 in adjusted gross income in order for you to get the full bump to $40,000. If you are a high income earner and you're well above $500,000, you're going to be limited on the amount of state and local taxes that you can take. Once again, year-end planning is very important because we need to make sure that we create every opportunity possible to get you below these income thresholds, now all of a sudden releasing all of these incredible benefits that are built into the BBB, the Big Beautiful Bill. No federal income tax on tips and overtime. There are limits to what you can earn, and there are income phase-in and phase-out thresholds. If you want to learn more about that, sign up for a free consultation. No federal income tax on Social Security benefits. We were hoping that it was going to be no tax in general across the board on Social Security income. However, the federal government at the 23rd hour decided to add a $6,000 deduction to offset tax liability on Social Security income. I did want to mention this particular change to the Internal Revenue Code. Just this one change, the no federal income tax on Social Security, but it ends up being a $6,000 write-off. That one little tweak to the code will lift 88% of United States taxpayers who currently collect Social Security out of a tax filing requirement. I know that we're probably all sitting here in California. Maybe some of you are outside of California, but for those of you who are sitting here in California, you're thinking, well, I mean, how is that possible? That's not possible. Well, just understand that California and New York are unique. We are different. We not only have Social Security, we have pensions, we have equity in homes, we have earnings from a spouse that is still working well into their 70s and 80s. I mean, Bob Hall still prepares tax returns. He's 82 years old. Okay, so California and New York are different, but as you can imagine, in the other 47 to 48 states outside of Hawaii, probably too. We'll throw Hawaii in there. 47 states, a majority of the United States population actually survives solely off Social Security benefits, right? And if their Social Security benefits in a married filing joint couple household are, let's say, $80,000, $90,000 in Social Security benefits, if that's their only income, it's already not taxable. This has been part of the code for a very long time. If your only source of income is Social Security, you don't have a filing requirement, it is non-taxable. The problem is that when you start to add Social Security onto capital gain and to dividends and to interest, maybe a small self-employed business or W-2, now all of a sudden that individual has a filing requirement. This particular deduction will change that. 88% of those Social Security beneficiaries or benefactors will be lifted out of a federal tax filing requirement. Wild, right? That's a wild statistic. So just keep that in mind. I mean, these are major changes that I'm aware of, but maybe you aren't. New auto loan interest deduction. Okay, you got to make under $100,000, or the phase out is $100,000 to $200,000, I believe. They're still tweaking this, by the way. I'm not sure if that is the full phase out threshold, but I do believe that auto loan interest up to $10,000 can be deducted if your income is below $100,000, and it will start to phase out and fully phase out at $200,000. Auto loan interest is only going to be deductible on U.S. or U.S. manufactured vehicles. It's not going to be available for BMW. It's not going to be available for Mercedes or Porsche or any of these foreign automotive makers. It is only a deduction for U.S. manufactured vehicles. One thing I do want to make you aware of, though, is that a lot of these foreign car makers, what they will end up doing is producing or making 95% of the vehicle abroad. shipping it here to U.S. soil, slapping the wheels and tires on, installing the GPS software system in the vehicle, and then stamping the paperwork as U.S. soil final destination of manufacturing. They did that back in 2017 when this was a stipulation in the bonus depreciation for vehicles. They're more likely than not going to do that again. Okay, not sure yet. There's a lot still up in the air with that particular deduction. An added charitable deduction is allowed for non-itemizers. So if you are not itemizing your Schedule A deductions, if you don't have a mortgage interest deduction, if you don't have high property taxes, you will automatically get a $1,000 charitable deduction if you're single, or $2,000 if you are married filing joint. And you do not have to itemize your deductions. So this is on top of the standard deduction. Okay, so be aware of that. Some really nice benefits there. Clean energy and EV vehicle credits curtailed. EV vehicle credits are gone as of the end of September of this year. So if you go out and you buy that brand new Rivian, great on the depreciation side, but you're not going to get the $7,500 credit anymore. So just be aware, EV vehicle credits are gone. Solar credits are still in play. For residential, they have to be not installed, but a contract has to be signed for install prior to December 31st. Okay. For commercial solar installation, you have out until 2027 to do solar on commercial buildings. Okay. So residential and commercial are two different things. They're treated two different ways. Once again, if you want more detail about this stuff, I highly suggest that you sign up for a free consultation. You can go ahead and scan the QR code on the screen. You could shoot me an email and say, Tony, I love what I heard. I'd love for you guys to take a look at my 2 years tax returns, see if I missed anything. Once again, this is a free consultation for you. And this is the best way to get a hold of us. Scan the QR code. It prompts you to sign up for the free consultation. Or if you just want to shoot an email to me, TonyWatson@RobertHallTaxes.com, say, need a free consultation, we'll get our boy on, who is the new client intake specialist at our office. He'll give you a call this coming week. We'll get you on the calendar, ready to rock and roll. Brett, that was a lot, man. That was a lot.
That was great. I mean, bam, 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 bam. Somebody just commented, I really hope there's a replay. And I totally agree, because this is one to watch a couple times and get,
just along those lines, Brett, I do want to mention that this is all good information through December 31st, guys. Okay. But next year, some of this stuff will be tweaked. Things change. Don't rewatch this next year. Okay. This is good through December 31st. Don't rewatch it next year, though.
We have a couple questions, and I want to be respectful of your time. So we're going to knock these out as quick as we can. Guys, if you have any more, type them in. We'll try and get to all of them. I personally have about 7 minutes left, so let's roll. What is the max a married couple can make and not pay tax on Social Security benefits?
So once again, are you saying outside of the Social Security income?
I think they're just asking about Social Security by itself.
So I believe that if you just have Social Security, if you make $90,000 in a married filing joint couple just on Social Security, none of it's taxable. Now, if you start adding interest and dividends and capital gain on top of that Social Security, I'd have to look at the code. I don't have the brackets in front of me. I think it's like 49 grand, I believe. Don't hold me to that, though. I would have to look that up. But if it's just Social Security, none of that is taxable. If Social Security is your only source of income, you pay nothing in tax on the Social Security income.
All right. And then Cheryl's asking, I own 6 houses in my self-directed IRA. I am going to be taking my first distribution this year. Would you discuss how that's handled on the tax return?
We can. And, along with Dimitri and Sense Financial, we have to calculate what your what the value of the IRA is, right? Because the RMD, the required minimum distribution, is calculated based on the ending value of the IRA as of December 31st, right? And your age. And in order to get that ending value, there would need to be some sort of fair market value appraisal of those assets within the IRA as of December 31st. We could plug it into our RMD calculators, figure out what that number is, and calculate it that way, and then that's what you take. Full transparency, though, I have seen a lot of people really, I don't want to use the word mess around, but really utilize this part of the code to their benefit, because how do you give fair market value estimates to a property without getting formal appraisals? Well, the government doesn't require you to get formal appraisals every December on your assets within your IRA, right? So there is a little bit of a process involved in this, but yes, we absolutely can help you calculate RMDs, show you what kind of tax implications that means for you, so on and so forth. That's a big part of our planning.
Absolutely. And I will add, you can distribute an asset to yourself in kind or cash. In fact, if you have proper accounting, you can distribute part of an asset to yourself, say 25% of a house each year for the next 4 years, it's obviously not going to be the same dollar amount each year because the value ebbs and flows of real estate. But in 4 years, approximately, you could own that house outright. Now, until you own it outright, you can't use it personally. The IRA still owns it and it's rental only. But just to let people know, it can either be a cash distribution, whether it's RMD or just a regular distribution, or the actual asset, which is pretty cool because if you have something in Roth, there's no RMDs, and you can distribute the asset to yourself completely tax-free as long as you've had Roth for at least 5 years. So super cool stuff, dude. I think, let's see, I lost it. Where did it go? I'm so sorry. Hold on. I scrolled up and down. It was about, okay, so I'm not 100% sure this question, but maybe you'll understand. Under Trump's new bill, and maybe the letter I is missing. Can I now deduct 100% of repairs for items such as roof replacement, and then can you deduct it 100% in the year it was done versus depreciate it over a number of years?
So in order to accelerate the depreciation on an improvement like that, if you're not just simply patching a hole in a roof, you're actually replacing the entire roof. In order to accelerate a good chunk of that, you'd have to go through a cost segregation election. You can't just put new roof as an itemized deduction on the return because it is a structural improvement, which technically would default to the lifespan of the asset. Now, some of these new roofs, sometimes the contractor will say it has a 40-year lifespan. Some roofs will have a 20-year lifespan. I'm not a roofing specialist, but I've seen contracts written in different ways. In theory, under tax code, it defaults to 27 and a half years because it's structural improvement. The only way to grab 100% of that new roof in this case would be to go through a cost seg election. And remember, cost seg only works on rental investments, not on a primary residence. None of this applies to your primary home. We're talking about rental investments here. So you'd have to go through a cost seg election carry in order to accelerate the depreciation, potentially at 100%. I don't know if it's going to be 100% though, because we would have to we use Jeffrey Gamm with GTG Consulting out of Pasadena. He's our cost seg specialist. There are only 50 licensed what are called CCFPs, I think is the term. There are only 50 licensed CCFPs in the US. Jeffrey Gann is one of them. And so he would be the better person to talk to about how to squeeze the 100% deductibility out of that roof, if that's what we're trying to do.
There you go. Awesome. This is a personal question, but I'm going to ask it anyway because I think it's really good. Can cost seg or bonus depreciation, whether it comes from a personal residence, not primary, but just like a rental that I own personally, or some kind of syndication, is all that carry-overable, or is it kind of use it or lose it in the first year?
Great question. So this is all part of the planning side, right? Sometimes we opt to take the loss deduction. I've had clients who have 5 or 6 rental properties and syndications, and we pick and choose what losses we want to use, right? So whatever we don't need, if we've already wiped out your taxable income and we don't want to show net operating losses, literally negative AGI, which is terrible to show a lender if you're trying to get financing, we can opt to carry forward certain losses as passive loss carry forwards or unallowed passive loss carry forwards, and you bank those losses up for future years. So no, you don't have to take it if you don't need it.
Excellent. All right. Cool, man. Well, hey, Tony, thank you so much. Really appreciate you taking the time to speak to the audience today. And
absolutely. Please reach out, everyone. Contact information is on the screen. Brett, always good seeing your face, man. Have a good one. Take care, guys.